Hello, everybody. My name's True Demon, and I'm the Devil Stockbroker. Today, this is our weekly meeting every Sunday that we have here for the Demons in Hell's trading floor. This meeting is going to be a little bit more dense than usual because we just got some really disturbing news that the EU is going to be lifting some restrictions on Darkpool trading and potentially considering lifting the payment for order flow ban that was instituted many years ago across all the European exchanges and the UK. Please feel free to join us for this conversation while we unpack this issue and discuss what the way forward is for retail investors across the world. Hey guys, how you doing this morning? Or afternoon, depending on where you are.
How's it
How
going?
you doing?
Good. How are you two?
Good afternoon.
Good afternoon, guys.
Good
afternoon.
evening.
Hey,
Get out of here. Get out of here.
You little tired, homie?
No, I'm all right, man.
You good? Okay.
Yeah.
That's perfect. Looks like everybody's getting picked up pretty well. All right. So
We're getting picked up. Oh God.
that's right. Y'all are going to be on TV. Better than TV, you're going to be on YouTube. So we had some interesting news come out. Trying to go and find the article, but apparently the European Union exchanges are proposing a boost to dark market trading and potentially even removing the ban on payment for order flow for the European Commission. The ETC apparently thinks that the market panic is being inflamed by all of the trading that's going to lit exchanges, and it's causing the market to drop much more quickly than it would if large institutions would be able to move their money and their equities faster and more fluidly in the dark market. So that's their sentiment on this bullshit.
How are they using the dark market to begin with? Weren't the large institutions going through them anyway?
Yeah, that's exactly what it's for. The whole point is the whole point of dark pool trading is to allow for large institutions to find liquidity and get their trades filled all at once across multiple customers and exchanges without actually triggering a major market sell-off, especially if there's say there's a huge order that somebody needs to fill for 1 million shares, just make up a number. If they need to fill the 1 million shares, the way that it goes out to the lit exchanges is it gets added to the order book, and the exchange will take note of the limit order, and any customer that is willing to sell at or below that limit order will be triggered instantly. Everybody gets filled right away. But the problem is that can create a huge market move because algorithms will immediately react to seeing that price, and they will adjust accordingly. And that can cause massive liquidity issues on a lit exchanges, especially since it's mainly just retail, small retail and institutional participants on those exchanges.
That's exactly where
the liquidity in that market makes it so that it can create a huge market move off of relatively low volume just because it's one large order. And that's how you get these huge jumping price candles, whenever something like that goes through. With the dark pool order, it's not quite that way. The order book is closed off to all others, so nobody can see each other's orders. They just go based off of prevailing market prices or whatever they're willing to pay / sell for. And anybody that gets filled in that market gets filled quietly, and the order is slowly allocated shares based on the other participants' orders until eventually the order is filled. Once the order is completely filled, then the market order is triggered and everybody gets their shares triggered for settlement and the exchange occurs. That single order gets printed to the tape and relatively no price movement occurs as a result. And then they have up to 3 hours to print that to the tape for the public exchanges. But, by that time, any price action that would have resulted from that is gone.
So I don't understand. So if they're already doing that, then the only thing that's left is retail, essentially, right? Smaller orders. So just sounds like lobbying, right?
It does. It's just it's mainly just lobbying. So this is the
Why
article.
trade at all if everything goes to the dark pool, except what's to the detriment of smaller traders.
Right. So this is the article that I found. EU proposes matching UK move to boost dark share trading, documents show. And this is per Reuters. So printed October 21st, a curb on dark or off exchange trading of shares in the European Union should be completely removed to compete better with Britain. EU documents seen by Reuters showed on Friday. The documents set out by the latest compromises among EU states on reforming the bloc's MIFID securities law to catch up with advances in trading technology and practices in markets. The documents also include an informal German proposal to scrap the European Trading Commission's proposed ban on payment for order flow, or when brokers get commission for directing stock orders to a specific trading platform. Dark trading has long been divisive in the EU, pitting banks and big investors who favor this anonymous form of trading against exchanges who say it damages prices on their quote-lit platforms, which display prices at which market participants are willing to trade. Dark trading is currently subject to two types of caps on volume, and the European Commission has proposed removing one of them. EU states that the European Parliament have the final say on the proposed MIFID reform, with negotiations due to continue over coming months before a final deal emerges. The Czech presidency of the EU is proposing the complete removal of the double volume cap, EU documents for meetings next week show. Quote, this will allow for a dynamic and nimble approach, allowing price formation, sufficient transparency, and leeway to react to situations within the EU or in the UK, the document said. That's literally the opposite of its purpose.
That's why I'm laughing.
It's the opposite. It's less transparent. That's the purpose. That's why it's called the dark market. It's specifically designed to remove transparency. Yeah. What the f*** is he talking about?
It's gaslighting. It's gaslighting.
It renders option trading for big float and blue chip plays pretty much useless to retail because they can do all the trading that they want at that point, and we would see no price action or very little up or down price action, so it would take our premiums away that much faster.
Oh my god.
We generally call it MIFID, by the way, TD.
MIFID? Okay.
The Markets and Financial Instruments Directive, yeah.
Gotcha. Thanks for that, Dave.
Yeah, they're trying to help out because big, they got themselves in trouble with the bank, so now they're trying to find a way to bail them out in different ways.
They want to offer them a safe haven. So if they can exchange on the London exchanges, they can bring some liquidity to London's markets, and they can get a little bit of help. Now the EU wants to get a slice of the pie. So the European Union's Trading Commission they all took the same measures together, okay? And this was all in place before Brexit, right? And then after Brexit, that's when the UK decided to lift a bunch of these restrictions. They did so recently, but the only restriction was on the double volume cap. The double volume cap mechanism, DVCM, Article 5 of MIFIR, aims to limit the trading under the reference paid waiver and the negotiable transaction waiver for liquid instruments in an equity instrument. Great, that makes it so much clearer. In particular, ESMA shall publish regularly the results of DVCM on its website. God, this is less than useless. Dave, do you have any insight on what the double volume cap rule is? Because I know you worked, you've worked on some of these systems in the past.
I have. I had to do a lot of changes for the original MIFID, which was like 15 years ago or something when they came out with that. We had to make a load of changes. But this is probably, I did some work on MIFID 2 as well, which is probably what he's referring to now, which was the second revision, which was came out a few years ago. But yeah, I'm not quite so familiar with that, I'm afraid. I know I'm aware that they put extra restrictions on Darkpool trading to try and get rid of high frequency traders, stop them being abused, basically, with the intention of the rules. I can't remember exactly what they were. I can try and find the document.
Gotcha. All right, I think I found a much more clear explanation of it. So the double volume cap limits the level of dark trading to a certain proportion of total trading in an equity. I'm assuming that the dark pool trading can't exceed more than double the volume of average trading, something like that. I'll have to dig into this separately so that we can get some clear answers on this. But this is exactly the kind of restriction that we wanted to see in the market. Like, we wanted to see volume caps, and we don't have anything like that here in the United States markets. And that's why they tout us being the most liquid market, the most transparent market, which I find to be hilariously that's a hilarious lie. Like, that's
that is totally a lie. The European markets are much more transparent.
European markets force all of your companies to actually disclose their short positions. We don't even do that.
Yeah.
Like, they have to include like your equivalent to the 13F filing that we make institutions fill out for all of their long positions exceeding 5 million shares, or I think it's 5% of a total company's outstanding shares, or maybe it's 5% of their tradable float, whatever it is. They have to disclose their long positions, but they don't have to disclose their short positions. It's voluntary. And of course, they're never incentivized to do it
every day as well.
Yeah.
Have you've looked at like a European stock on Ortex, and seen all the difference in the level of information you get?
Yeah. You check on any of the European companies on Ortex, and it's like, there's the information. This is the last reported info. You know that this is accurate, and they're able to report it
yesterday,
right? And they can report it. They can report it, to the day, to the previous settlement day, because that's when settlement completes in Europe. God, our markets are screwed up, like beyond screwed up. I'm sorry, I think I cut you off, Scrap Queen. Were you about to say something?
Yeah, I was just looking through trying to find articles, and it looks like this is really being pushed by the UK and then Germany, and you see the standing that they're having and the problems they're having. It looks like it's mostly beneficial for them and maybe not so beneficial for everybody else.
Well, of course it is, because they have the biggest exchanges. You have the Frankfurt Exchange in Germany, and then you have the London Exchange in the UK. Those are the two largest exchanges. They provide the most liquid markets.
We also have pattern day trading or payment for order flow.
Right.
They make these. They're going to like the match that's going to collapse. This is dangerous, so dangerous.
And they think they're helping things. Like, this is being sold as a measure to help provide liquidity to the markets. This is literally going to be used for everybody to get out of their shit, fire sale it into the ether, and then disappear with everyone's money to the Cayman Islands or Panama or wherever the hell they can take it to.
This is just, an extension of what's going on. The power challenge is the power structure is being challenged, and this is what they're doing.
Well, they can help by not helping.
I'm sorry?
It's nothing.
I said they can help by not helping.
It's nothing to really be surprised by.
This is being lobbied by those, the wealthy who can take advantage.
Yeah,
right?
but all these rules were put in place after the
2008.
Yeah. So basically, it was 2008.
It was to prevent abuse, correct? It was supposed to prevent abuse. So who's doing the abusing, right?
A report was commissioned, and it highlighted all the problems, and then we fixed all the problems.
Yeah, you guys acted on it. We didn't. Or we did it in theory, but we never really followed it.
Yeah,
right.
There was a similar report in the US.
Yes.
Remember the last crisis, everybody left America and went over to the UK, where all the standards were looser. And now some of those standards are locked up with these changes they're trying to undo. Maybe now the people in the U.S. that would normally run to the UK and hide all their trading off exchange and, stuff all their stuff behind in the corners where people can't see them. They don't have those avenues right now, so they're trying to get them probably.
That would be probably logical, Screckling. Like I said, this is all coming to the the manipulators are attempting to be able to manipulate again. That's what this is all about.
Which goes back to why
I think they felt so safe for so long they didn't even realize that they were underwater right now or that it would even be a problem. I think they just like, not even that they laughed it off. I think it wasn't even a thing in their mind because people have had this way of life for so long. And I think that like maybe a domino has been pushed and they're panicking finally, at least the people who know, like their account managers who manage their account realize, oh, something's up, something's different. And I think that's only just begun. That's only just begun, the acceptance. Other people might have noticed before, but the acceptance of it actually mattering in our lives, I think that's just started.
And
I have lack of liquidity.
Yeah. I never understand why people think that you can exponentially make money going in one direction with a certain type of vehicle or trade and never think that it can never reverse or unwind or come back in the other direction as if the market only goes one way. If you're making exponential money on the way up, something could cause it to go in the reverse direction.
Well, there's an answer to feeling of privilege.
There's a difference that everybody gets involuntarily on the way up, but the force on the way down gets pushed on people that had nothing to do with it. That's kind of the problem.
Well, that is. I mean, that's what the wealthy do. I mean, that's the abusers, is that they take advantage of these type of trades initially, and then they don't have to worry about the ramifications later. They know that eventually it's risky and they have to make good, but they count on the system to bail them out. This is really, I mean, this has become the way of life, you know, too big to fail.
And I can give even the shorter answer to that.
Okay.
It's the same. They do this. They use the same stupid drug that we as retail use every stinking day. Opium. They see the risky plays. They see this stuff, and then stuff starts to line up in their favor, and they go, oh, and that opium kicks in. And some of the people that are starting to see it unravel are saying, oh, God, I need to get out of Dodge right now. And others are going,
But they go in knowing that they have the power to lobby.
Yeah, they have the ability to manipulate conditions in the market to make it go and create the conditions that they need in order to either make their positions profitable or get out intact.
So they go in not. I disagree that it's kind of with opium, but they go in knowing that they have a backup. Right, that they have a get out of jail free card. So they're not going in like the typical trader you're talking about who sees greed and like a bull charging red flag and doesn't think about the after, you know, what could happen.
But they still have the emotional response, I think, is what Echo is getting at, and I do agree. But they also have that leverage to be able to manipulate and lobby in order to get conditions just right so that they can exert their will on the markets and make them.
But they go in half emotion and half greed, right? With half rational, whereas we go in completely for complete greed. That's
the problem. That excess leverage. There needs to be checks on that on the way up. That's a drug.
Every time a proposal like that comes out, some asshole steps out onto the floor and then talks about how harmful that will be for the markets and the liquidity. They start whining in front of all of the constituents, and then they're able to convince them. They gaslight them into believing, like, well, we can't do that. We can't make it harder for people to move their money around. That would be bad. And then they slowly slip that stack of fucking $100 bills into their pocket and shut their mouths, and then they abstain from the vote.
Well, it's the same thing that they do with the rest of the politics, right? I mean, they gaslight. My wife is from Brazil, and, you know, they're in the middle of an election, and they have a runoff. And there's two candidates. One is like, theoretically the hard right, and one is theoretically the left, right? The guy on the left was impeached and went to prison. He had a corrupt judge on their version of the Supreme Court who somehow got him, commuted his sentence or something, pardoned him. I don't know how that happened. Guy's running again, but what the guy does is he handed out a couple checks to people, right? He gave them a little bit of money, kind of bribed them to vote for him. But the guy on the right is really the guy who's better for them. He's trying to get rid of the corruption in Brazil. Right. But they're gaslit into voting for the guy on the left who, preaches says all the right things, but doesn't really follow through with, gives them a small piece of change, but in retrospect robs them blind of the bigger stuff, right?
Talking about Bolsonaro.
I'm talking about Bolsonaro and Lula, correct.
Yeah.
We see,
and you so that's an example. You know, the gaslighting that goes on there. That basically they basically fooled him. They bamboozled him. And people go, oh, he gave us a check, like a stimulus check or something. No, he's great for us. When basically they're passing laws that their tax rates are like twice what it should be, if you know what I'm saying, or something like that. And he's gotten caught putting funneling money into his own pocket. So what does that tell you? How much of a left? How much can he be representing the left when he's corrupt?
Yeah.
But it's the same thing. It's happening all over. They get people in here too. People vote against their interest all the time, and we will do so again in this election, as you know, True Demon. You famously railed last week, and unfortunately, that's what's happening. It angers me. You can't talk sense into these people.
Well, that's why I keep saying, like, nothing's actually going to happen in favor of the masses until the masses decide to get violent. Not that I want to see that happen, but that's what eventually.
You're right.
That's what this all leads to. Once people start starving, then they'll get upset and they'll look around them and ask themselves, really, like, who do we have to be angry about by the fact that we have no money and only the politicians have money and all of the wealthy business elites have money and all of them have now fled to the nearest Pacific island and we have no boats. Now what do we do? So
yeah, that's kind of where we're at. We're getting to that point. I think we're pretty close to that point now. If you looked at the polls and look at people coming out right for the election, this is like remember we used to have trouble getting 50% of the people to come out to vote. We're up to 70% this election. That's what's projected as the percent of eligible voters who are going to vote. Wow. Not because they're doing the patriotic duty, but because they are desperate now, because they feel there's a heightened alert.
I think you brought up a really good point on something, TD. When you mentioned about how they're trading and how they're moving the money because they have the massive amount of leverage, I think you brought up a really good point that it sounded great on the surface and it sounds even better when you dig into it. You separated the people with the massive amount of money actually to two different groups. And I think that's what it's going to be a bigger pivotal point there with everything that you just brought forth with over in the European markets and what our market's doing. There's going to be the group in that group that you mentioned that they're going to be super emotional. They're the guy that whatever their expertise in the market is, whatever their personality is, whatever, they're going to be emotional. They're going to be scrambling to make things work, to get that leverage.
What are you talking about, Echo? The retail? I'm not following.
I'm talking about the dudes that had the leverage to move the market. That ain't us.
Okay. All right.
That's what TD was talking about, is the guys with the leverage to move the market. Mm-hmm. There's two groups that TD brought up without bringing it up. And there's the guys that they both have the same kind of leverage, but there's the ones that they will not think rational. They'll see things going and they're going to go, oh, crap. And they're going to move emotionally with it. There's the other group that has similar leverage, but they are going to think rationally. So what we could see potentially if we dig deeper into this and watch it is there's now going to be a struggle between those two different mindsets. Because to say that everybody's going to think rational is ridiculous. To say that everybody's going to think emotional is ridiculous. But we're going to see that struggle internally now. And the ones that are thinking rationally are going to want to put away the ones who are being emotional because they're going to wreck what rationally is needing to be done. Because that's what happens every time. Those with the emotions high in what they do, it wrecks everything. And when they start having that struggle internally with the dark pools and the bigger market leverage, we might start seeing that on our end, that back and forth, because they're going to start moving assets back and forth even more with all this stuff going on. And we could start seeing swings that are wider towards our end because of that struggle back and forth. That's my takeaway from what you said.
I'm trying to understand what. So, can you put it like in examples of specifics? Maybe who would be the rational and who would be the emotional, and how that would impact us? Like, is it on the commission?
I think that what Echo is getting at is that there's a mixture of players in the market. That's you have both types inside of these financial institutions. You have the ones that are much more cold and calculating about it, that understand that once the music stops, you need to find the chair, and they are going to look for those that are still trying to turn the music back on and cut them out of the game.
Okay, so the ones who, in other words, who would lobby still to keep the print on principle,
right,
as opposed to what's best for them.
Right. Some of them are. There are plenty of individual. There could be whole firms, or at least the leadership of these firms, that are in denial about the trajectory that the entire economy is going on, of what their company is capable of what market conditions are, or where they're going. Many of them are in denial about this. And the ones that have seen this before, that have understood and analyzed the market, and they can do the cold, calculated math in order to decide this is going to happen no matter what you do, and anything that you try to do to stave off the inevitable will only make it more painful in the long run and hurt more people along the way. So they're going to look to find who those actors are that are being the emotional, greedy bastards that are trying to prop this thing up and keep it going for as long as possible. And they're going to probably look to take advantage of their stupidity, not necessarily in malice, but just look at those idiots like, I guess you're going to be the one to take the fall then. Because the ones that are making the emotional decisions are easy targets. They really are. And I really hate to use Jeffrey Yass as an example, but he is a person that does do this. He's one of those cold calculating bastards that will look at the conditions of the market and look at the people that he's playing against, and he is going to target them. That's why he targets retail. That's why Susquehanna targets retail investing, or any stock that is heavily invested in by retail, because he knows that he can bamboozle them because they're not working with the right tools, the right type of information, and they're very shut out of the insight to the market that he and his entire trading firm has. So
you're saying, right, that he's lobbying for these to be able to manipulate, right?
Right. He has made the ideal conditions in order for him to steal from regular working people who are just trying to invest in companies that they believe will be profitable in the long run. Jeffrey Yass doesn't give a shit. That's my take on it.
No, that I would say that's probably the majority of the institutions, though. They tend to be more cold and calculated. It's a business to them. It's business decision. They're not losing their savings.
Right, but like institutions that make their entire business model, like their entire business model rests on the foundation of stealing from working class individuals. That's a different level. A lot of these institutions, they make money other ways. They make money off of the interests of loans, off of quality, quality devices.
Financial? We're talking like companies, Fortune 500 that make investments. I mean, are we talking just about like banks and hedge funds and stuff, or are we talking about a broader based market?
I would say mainly financial, but that's not just limited to banking institutions, market makers, and such. Like there are other investment firms. There's the mom and pop hedge funds, the small institutional investors that are trying to make this work with the market conditions that we're still trading with. They may have better tools, but they're still playing by the rules.
Right. We're talking about the main guys, the ones like the Bank of Americas and the Citadels, who are the ones who are going to be cold and calculating, who make that their business model.
Right. They go and find they find the smallest fish and they nibble on them.
Yeah. No, we're in agreement on that.
We gotta keep in mind, though, we talk about Bank of America like there's one person making decisions, but their downfall can be the hive mind itself, in that no single person is actually making all the decisions, and the monster can eat itself in that each person only does up to what they're incentivized to complete. And in a way, they will not exactly fraud in their position, just their individual position, but for some people it is fraud, but manipulate their numbers or their reports to say what their superiors want it to say, even if they were or weren't told that. That's taking place at every level of every individual in the hive. Nobody's stopping to really look, except for maybe at the very top, if that guy isn't golfing up. Maybe if the top guy is out golfing all day and isn't even looking at the bigger picture, and the hive is running itself, and it's become its own monster that can eat itself, because nobody is actually looking to see if all the numbers add up at the end of the day. And I think that they are finally starting to do that and maybe realizing it, and that's what we're seeing with trying to get, different under the rug, like laws passed, or what, behind the I can't think of the phrase, but back in the shadows, trying to get everything taken care of, trying to have quote unquote extra liquidity from the government, and
behind closed doors.
Behind closed doors, thank you. Yes. Sure. I haven't had any coffee today.
No problem.
I'm just only trying to say that there's no incentive for each individual working in the institution to cause the institution to succeed. They only want their paycheck to succeed or to get their Lexus that year.
Right. That's actually a really good point. And I'll actually bring up a story that kind of reflects that. So this is a interesting this is kind of taking us back to the back in time, back to 2008. But Morgan Stanley famously had the largest losses on Wall Street during that entire crisis, and it was because they ended up getting they got involved in bets with Michael Burry, but they also got they got other investors to buy credit default swaps off of them. So Morgan Stanley, during the height of the subprime crisis, was holding on to all of the contracts for short bets. So they were on the short side, or they sold the contracts. So they were on the hook for the insurance payments if all of these mortgage bonds failed. And it wasn't even like a company-wide decision to do this. What it was is you had a floor of investors who were in the mortgage lending department that didn't understand the devices and didn't really have a full grasp of what was in them. Whereas Dr. Michael Burry had already gone through the trouble to read all of the terms of these mortgages. Like he read them all, which I find to be a little bit outlandish. I doubt that he literally read from beginning to end the hundreds of pages of contracts per mortgage bond, but I'm sure that what he got was a good grasp of the terms of what their interest rates were, what the qualifying income was, and a lot of it was none at all. And the long and short of it was that Michael Burry knew that all of these triple B, double B, single B bonds were going to be worthless because eventually the bank would realize that they'd been not receiving payments for them and that they were never going to receive payments for them. So their investors would be out millions of dollars in returns, and the bank was going to have to face the prospect of defaulting those mortgage bonds. And because Morgan Stanley was holding onto these contracts, or rather all of these individual mortgage originating staffers saw these bonds as like, this is fine. Like, they can't all go bad, right? Like, most people will still pay. There will be some defaults, but there's no way it can totally fail. They just had this mindset of denial. Like, there's no way it can go that wrong. So they sold the credit default swaps with full confidence that they would never fail, but they started to. And then what they did was they started to collateralize this stuff. And one of the ways that they did it was they started buying mortgage-backed security credit default swaps of their own from other firms. They bought them, but they had to pay premiums on these constantly. So in order to offset those costs, they sold more credit default swaps, but for higher rated bonds, and they sold a lot of them. And by selling those credit default swaps for higher rated bonds, because those bonds are they're considered less risky, those bonds paid out smaller premiums. So they had to sell more of those credit default swaps in order to offset the costs of buying credit default swaps for more risky bonds. I'm hoping this is making sense. And maybe I'll have to draw it out on TradingView or something to make it a little bit easier to understand. But essentially, it's kind of like selling a credit spread. They sell the farther out option in order to buy a closer to in the money option. But if the bet goes way against them, then their losses can be way more excessive because of those contracts that they sold. It kind of works in that way. So all of those contracts that they sold those bonds also failed. And those were like AA, AAA bonds. Some of them were considered so safe that they were valued at tens of millions of dollars each. And they sold those credit default swaps on these assets, thinking that these are rock solid. These are like embedded in concrete. There's nothing that can make these things fail. Everybody's got like perfect FICO scores. They've got great credit. Nothing can go wrong here. Not realizing that you have they literally sold 5 homes or more to people that only had one source of stated income. And they kept doing this over and over again. So you had people that had 6-figure salaries that had like 3, 4, 5 homes. But once the downturn hit and once the subprime crash destroyed property values, they all panicked and they all tried to get out of their mortgages at the same time. And then those bonds failed. What this eventually cascaded into was this domino effect of more and more safe bonds in the mortgage-backed securities market to fail because of the panic that just bowled over everybody. And Morgan Stanley was one of those banks that was holding on to all of the short sides of those contracts, so they were left on the hook for all of the losses. It was 37 billion. It was 37 billion dollars that they lost at the end of that crisis. And that didn't come out until after Bank of America had bought them, which is why Bank of America's stock took a nosedive so hard early on in that year.
Yep. Can I just add, didn't they also begin selling those swaps to people that had no vested interest in the house? So you could have like 50 swaps on the same thing. So when one thing went bad, the over leveraged on each one was just out of control. And then you take the number of them and the volume that there were, it was just exponential.
That was AIG that was the biggest example, but yes, that was possible. So AIG was the example of one of those firms that did exactly this. The way that it works is that you have one bond, right? You have one. Let me actually go to TradingView and I'll draw this out. And just to keep it appropriate, we'll put it on the VMBS ETF. Okay, so over here we have a standard mortgage-backed security. I don't have my tablet on my desk anymore, so my drawings are going to be really terrible. I hope you'll excuse me. So we have an MBS contract here. Okay. Now this MBS contract, we'll say this thing is worth 10 million. That is the value of this contract by the bank. That once this bond matures, it will pay out $10 million. Okay. Now this gets sold to a pension fund. The pension fund decides that, okay, this $10 million, I definitely want to make sure that I get that return. Like this bond, sure, I'll consider it like safe enough, but just to make it a little bit more safe, I want to go buy an insurance policy on this bond so that no matter what, I will receive my $10 million return for my customers. So the pension goes to an insurer, AIG. That's American Insurance Group. So AIG, they want to pay AIG an insurance premium in order to secure the $10 million of this bond. So AIG says, sure. They go ahead and they provide a credit default swap to the pension fund. And then what happens is if this bond fails, then the pension still receives the $10 million, but they receive that $10 million from AIG. So that's what happens in the event the bond is bust. AIG pays the pension the money, and the pension gets all of their money back all at once. Okay? They don't have to wait for the bond to mature, and the bond failed, so it's all right. And in actuality, the faster the bond fails, the better it is for the pension fund, to be honest with you, because then the pension receives all their money in their returns back in this condition without having to wait for the bond to mature. So it's actually better for the pension to see the bond fail. It's a quicker return, ironically enough. But that's not the point of this anyway. So let's just say that this failure hasn't happened yet, though. This failure is still yet to happen. This is in the future. AIG is going to receive from the pension fund, we'll just say a premium. And this could be, this is probably like a relatively modest amount. Like it's, we'll say like $100,000 every month that that AIG has to take from the pension fund. That's what the pension pays out to them for their insurance premium. So AIG thinks like, hey, this is pretty great. Like the only thing that this bond is good. Like we'll say that this is a double A rated bond. Okay, double A rated bonds are pretty safe, and the chances of this thing failing are like somewhere in like the less than 5th percentile. Like it's less than 5% chance that this bond fails. So AIG feels like, okay, this premium is pretty certain and this bond looks pretty safe. Why don't I just sell more of this? So they do that. They go and sell this credit default swap. They take a CDS and they go and sell it out to dozens and dozens and dozens of other hedge fund managers. So they sell this credit default swap to all these different hedge fund managers. And we'll say that they do this. Like 10 more times. There's a total of 10 of these credit default swaps in existence now. That multiplies this entire bet, this $10 million bond. If this bond fails, then AIG is out $100 million. And AIG probably doesn't actually have $100 million just lying around. And the premium that they receive for all of these credit default swaps might pay them out. It might pay them out the entire value of the bond by the time it matures between all of the credit default swaps that they've sold. But they're levered for $100 million that they have to pay out. And say AIG doesn't actually have that money, guess who's out? All these dudes are done. Like they don't get their money. AIG just declares bankruptcy and then they're out the money. And this is exactly the kind of cascade that occurred down in 2008 when things started to like truly collapse and come undone. So this situation is exactly what I believe that we're facing in terms of short liquidity and the treasury bonds collateral problems that we're having across the market. We're already seeing what just happened with the UK gilt crisis. They had to prop up their entire bond market just so that pensions didn't get destroyed, just completely annihilated. So if this were to translate to U.S. markets, it'll be even more disastrous because I don't think that the U.S. even has. I really don't believe that the Fed is going to even attempt to save things at that point, because now it's gotten so bad. They've had the money printer on for so long that if they even tried to prop up the pension funds, it would just create a fire sale in the market. Like everybody would dump their assets and go over to cash and then transfer that to metals, something with intrinsic value. The dollar would inflate so quickly that they would never be able to stop it. And the Fed's job would be unending. It would completely annihilate their credibility. And our market is worth like $35 trillion just in equities. Our bond market is more than 5 times that size. If U.S. Treasuries just go into full fire sale into the market, and it's done, and all of the payouts happen with Fed money, with printed money, it will destroy the dollar. It will be a far gone conclusion. The credit default swap situation is more speaking to like this hive mind issue of institutions, this delusional thinking where you have like 1 or 2 really stupid people at these firms making extremely bad trading decisions that can lead to this kind of situation like Persephone was talking about. But I'm also worried that this same situation is happening elsewhere in the market as it pertains to like collateral using treasuries, securities, and stuff. And the panic is starting to show up in multiple markets at once. So I guess I've been waffling on for a while now, but that's kind of where I think that we're heading, where we're going to start seeing the cracks forming in these institutions, and the stories are going to start to leak out that like, oh, we had this one trade. We already had it. We already had something like that happen where where JP Morgan was caught based on audit records that their metals trading desk was cooking the market. They were fixing the market in their favor so that they could steal from people. They were actually using well-known manipulative tactics to affect the pricing in the metals market, and they had to admit to that, and they paid a stupid speeding fine that honestly like doesn't even come close to fixing the problem. But like those things that are being uncovered just by the SEC and FINRA's involvement, just looking a little further beneath the surface, I can only imagine the kind of shit they're going to find once things really start to get bad out there, and once people start panicking and start looking for a scapegoat, somebody to blame. AIG was an easy example of somebody to blame in 2008 because they made it so obvious in the way that they lost their money, and then they touted their success of getting bailed out by going and throwing a party for all their executives and giving them a bunch of raises. Like that just boggles the mind.
Okay, now I'm angry all over again.
Sorry, Scrap Queen. See, this is the kind of thing that I'm holding inside every single day, and everyone wonders like, I wonder why TD's so mad. I wonder why he has high blood pressure. That's going to do it for this video. Thank you guys so much for watching. We really appreciate having you tune into our conversations that we have at the Demons meeting. If you want to be a part of this conversation and join us every Sunday, we have this meeting at 1 p.m. Eastern Time every Sunday where we would discuss all different types of things going on in the market, current events, news, as well as cover every member's personal ticker requests before the market begins on Monday. So if you want to be a part of that, you can join us at Hell's Trading Floor and sign up for the Demon membership, the top tier membership for the trading floor, where your support goes directly to paying for resources, data providers, and additional tools that help Hell's Trading Floor make the market work for them. Thank you guys so much for watching. If you enjoyed the video, be sure to leave a like, subscribe to the channel if you want to see more, and I will see you next time. Until then, have a hell of a time in the markets.